If you've got some cash that you want to save, but are unsure whether to invest in shares or a money market fund, then this is the video for you. Because today we're going to take a look at both options and find out which one is right for you. I make regular videos to help you get the most out of your money, so let's jump straight into it. So what are our two options? Well, shares are one option, but what exactly do I mean by this? Well, when you buy a share in a company, you're buying a tiny piece of ownership in that business. So if you bought one share of Apple, for example, you would own 1/161st of the company. And when you own part of a business, you'll typically receive some of the profits in the form of dividends, as well as having the potential for your piece of the pie to grow larger if the company does well. The second option is a money market fund. And these funds invest in really safe, super short-term debt from governments and large companies. So for example, here in the UK, I can invest in a fund like this one, which invests in the very safe debt of the UK government, which is known as gilts. Now, because these investments are so safe, money market funds are considered to be almost as good as cash. Hence why many people use them as an alternative to keeping their money in a bank account. And actually, if you're in the UK, you could even use a cash ISA to shelter your money away from the taxman, which we'll come back to a bit later. But first, let's start off with a look at the risks, and then we'll look at the returns. So let's start with shares. Now, the big advantage here is that historically, investing in shares has been the best way to grow your wealth over time. If we look back over the last 20 years, the S&P 500 has given average annual returns of around 8%, which means that £100 invested in 2002 would be worth over £300 today. However, there are two disadvantages to consider here. Firstly, share prices can fall significantly in the short term, and there's absolutely no guarantee that the share price of a company will increase over time. Just look at the recent GameStop saga, where a share that was trading at $4 at the start of the year is now trading at less than $1. Secondly, unlike with a money market fund, there is no guarantee that you'll receive any dividends, and certainly no guarantee that they will increase over time. This means that relying on dividends to fund your retirement could be risky, because if those payments stop or fall, it could leave you with a shortfall. Now let's take a look at money market funds. The big advantage here is that they offer higher interest rates than most bank accounts. And so if your goal is just to keep your money safe and earn a bit of interest, then this could be a great option. Money market funds are also really liquid, and this just means that you can get your money out whenever you want. In fact, some platforms allow you to withdraw money on the same day. There's also no risk of capital loss, which is another advantage over shares. Okay, so now that we've covered the risks, let's have a look at the returns. And let's start off with shares again. Well, as I mentioned earlier, over the long term, shares have proven to be the best performing asset class. And I know that you might be thinking that we've just come through the worst pandemic in living memory, and it's understandable that you might think that investing in shares is too risky right now. But let me ask you this. Did you know that the S&P 500 saw its best year ever in 2020, when the world was shut down and everybody thought the economy was about to crash? In fact, if you had invested in February 2020, when the S&P 500 was trading at its lowest point, you would have made almost 70%. Of course, nobody knew that the economy would bounce back so quickly after the first lockdown. And this is my point. Trying to predict when to invest in shares is incredibly difficult, and you could end up making a big mistake. The solution is therefore to keep investing regularly and consistently. And this practice is known as dollar cost averaging. Now, there is lots more to say on this topic, but I've made a whole video about dollar cost averaging in shares, and so you can watch that next. For now, though, let's move on and talk about money market funds. As I mentioned earlier, these funds offer higher interest rates than most bank accounts. However, if we look at the interest rates currently being offered by banks, they are at rock bottom levels. And this means that a money market fund isn't offering much better rates than a bank account. Now, some platforms will offer slightly higher interest rates if you keep more of your money with them. But this isn't usually enough to make a big difference. Okay, so let's summarize the pros and cons of each option. So starting with shares, the pros are that historically they've delivered the highest levels of return. They're suitable for long-term goals, and they can provide income through dividends. However, the cons are that you could lose money in the short term, and there's no guarantee of future returns. Moving on to money market funds, and the pros are that they offer higher interest rates than most bank accounts. They're very liquid, and they carry no risk of capital loss. However, the cons are that the interest rates offered are very low, and they are not suitable for long-term goals. Okay, so what have we learned so far? Well, if your goal is to keep your money safe, then a money market fund makes a lot of sense, especially if you need to access your cash regularly. However, if you're saving towards a long-term goal and you don't need to access the money for a few years, then investing in shares could be a better option. But there's one other thing that we haven't talked about yet. And for many people in the UK, this is going to be the deciding factor between the two options. What am I talking about? Okay, so hopefully that helps you decide between the two options. Remember, if you want to learn more about investing in shares, check out my video on dollar cost averaging. Also remember to check out the resources that I've linked below. Finally, if you enjoyed this video, please hit the like button and subscribe. Thanks for watching. See you next time.